Hey traders and investors, Jason here from Leavitt Brothers. Today I'm going to talk about the decennial pattern or decennial cycle. This is a study of how each decade of the market has played out. The numbers aren't random. Clear trends have emerged over the years, and to be honest, I don't know of any good explanation. Most on Wall Street can explain why stocks do better or worse during different years of the presidential cycle, but there are no good explanations as to why stocks do better in certain years of each decade. Along with the discussion about the major tech cycles I did about a month ago, this is the most bullish concept I know of, a concept that would suggest we may have some weakness ahead of us in the next few months, but after that, the next couple of years should be very good. This is not meant to be an exhaustive look at the phenomenon. Instead, I'm going to focus on years ending in 7, since the current year ends in 7, and then take a quick glimpse of the next couple of years. Okay, first the numbers. From 1886 to 2009, here is the average Dow performance for each year of a decade. Okay, so the first bar is the average of all years ending in 0. So 1890, 1900, 1910, 1920, 1930, etc. are all averaged together to form the first bar. The other bars are formed in similar fashion. The first year of each decade, years ending in 0, is the worst. Okay, things get progressively better, and then years ending in 5 are outstanding, by far the best year. Years ending in 7 are the second worst, and then the market does well the last 2 years of the decade. But let's dive in a little closer. Years ending in 7 are only bad the second half of the year. Here's the same chart with each bar broken into H1 and H2, first half and second half. Even though years ending in 0 are the worst of the decade, only the first half of those years are bad. For years ending in a 7, losses are concentrated in the second half of a year. Okay, as noted on the chart, the median return, the second half of years ending in 7, is about 9.3%. Okay, the worst 6-month period of any decade. This is where we are right now. Okay, this is the median return. The average drawdown is a whopping 20.7%, as shown here, also the worst of the decade. Here's a look at the path the S&P 500 has typically taken the last 20 years. It's shown in blue. This includes good years and bad years. The market has typically started the year flat, then rallied up for several months into late summer, where it tops, then it trends down into October, and then it rallies pretty hard into the end of the year. Okay, right now, we're in the second week of August, okay, which is just as prices on average have started to trend down. Okay, so good years and bad years, years ending in 0 or 5 or 7 or whatever, this is the average. Here's a look at the average of years ending in 7, going back about 80 years. Okay, it's shown in blue. You can see the market tends to do well the first half of the year and then peak in mid to late July and then tread down with pretty good force into mid-October. This is a similar pattern to what I just showed, but it's exaggerated. The move down is much more pronounced. For whatever reason, the second half of years ending in 7 have not done well. This pattern, weak, the second half of years ending in 7, has played out during both bull and bear markets. The green curve shown here shows the 10-year pattern during bull markets, while the red one shows the 10-year pattern during bear markets. Even in bull markets, the market has tended to move down with some force at this time of year. But while the numbers point to weakness in the coming months, they also point to good times returning once we get through any soft patch that plays out. Here are the gains by each year of the decade again. The last 2 years are each positive. Zooming in, none of the last 4 halves of the decade, half years of the decade, have a median return below 0. And remember this chart, look at how the market tends to finish each decade. Personally, I dislike historical studies because whenever you take the average of a big set of numbers, you get something in the middle that has so many data points far above it and below it that the average is something in the middle and it doesn't have much meaning. But this data set is actually pretty small. There are only 10 years ending in 7 the last 100 years, so you're not getting the average of a large number. History doesn't have to repeat, but at the very least, we need to keep this in mind, that the market tends to be weak the second half of years ending in 7, but then bounce back the last 2 years of the decade. Okay? And if you combine this with the tech cycles I've discussed before, there's reason to be optimistic the next couple years will be good. Okay? If the last 2 years of each decade tend to be strong, and the next 2 years coincide with the end of the 25-year internet cycle, any weakness that plays out over the next few months should be considered a gift. Leavitt Brothers is a boutique research firm which offers market analysis and trading ideas to investment advisors, hedge funds, and full and part-time independent traders. We solve the problem of knowing which side of the market to be on and what to invest in at any given time. With a delicate blend of quant research and discretionary analysis, Leavitt Brothers has helped its subscribers outperform the market by being in the right stocks at the right time. We offer daily and weekly reports to keep you on the right side of the major and minor trends, and trading and investing ideas to keep you positioned in the right stocks at any given time. There are 2 Leavitt Brothers sites, leavittbrothers.com and leavittbrothers.net. .com includes everything, daily and weekly reports and trading ideas, and there's a message board where many talented and profitable traders hang out and talk about the market during the day. The .net site unbundles everything so you could subscribe to just what you want. Some traders only want our weekly analysis, other traders only want our trading ideas. Come join us. Let's make money together.